Welcome to the Explainer. Today, we're going to go on a bit of a quest to figure out how financial pros separate the hype from what's actually real when they look at a company. It's all about finding the story hidden inside the numbers. I mean, it's the million-dollar question, isn't it? How do you really know if a company is a rocket ship about to take off or if it's actually a sinking ship? Well, I can tell you the answer isn't usually in the flashy headlines or what's buzzing on social media. Nope, it's in the data. And the main tool for that job is something called financial statement analysis. Think of it like a toolkit that lets us become financial detectives. We get to piece together all the clues from balance sheets and income statements to uncover what's really going on with the company. Okay, let's dive in. So our quest begins in a place you might not expect, by looking backward.
Yeah, it sounds a little counterintuitive, but if you want to have any shot at figuring out where a company is going, you absolutely have to understand where it's been.
You see, a company's financial statements are so much more than just a report card. They're like a diary, a super detailed diary of every strategic choice, every success, every failure. It's all written down in the language of numbers. Let's look at a classic example to see what I mean. Apple, between 2007 and 2010. Now, the raw numbers here show some pretty massive growth, right? Sales nearly tripled. But that's not the real story. The strategic story is hiding in the mix of what they were selling. So back in 2007, what was Apple? It was a computer company, mostly. Macs made up almost half their sales. The iPod was a huge deal for sure, their strong second act. And the brand new iPhone? It was just a tiny, tiny 3% sliver of the whole pie. But then, wow, fast forward just 3 years to 2010, and the entire picture had completely flipped on its head. The iPhone absolutely exploded to become their #1 product, making up almost 40% of sales. All of a sudden, Apple wasn't a computer company anymore. It was an iPhone company. And that just shows you how looking at past data can reveal these huge, fundamental shifts in what a company is all about. Okay, so once we have a good grip on the past, our quest turns to something a lot trickier, trying to predict the future. This is where analysis becomes a bit of an art form. But here's a huge warning sign you have to pay attention to. The past isn't always the perfect guide. You just can't assume what happened before is going to happen again. And the stability or instability of a company's business is a massive factor here. Think about it like this. For a super stable, diversified company like Johnson & Johnson, using their past profit margins is a pretty reasonable starting point for a forecast. It makes sense. But for a commodities giant like BHP Billiton, their profits are tied to these wild boom and bust cycles of global prices. For them, the past is a much, much less reliable map for the future. All right, now for what might be the most fascinating part of this whole quest, the reality check. This is where a great analyst really earns their stripes. Their job is to adjust the numbers they're given to see the true economic picture that's hiding behind all the accounting rules. So you might think you can just take the financial reports from two different companies and compare them, right? Well, the answer is a big, fat no. Different accounting choices can paint totally different pictures, even for companies that seem almost identical. You gotta dig deeper. Let's just take one example. How companies account for their inventory. One might use the FIFO method, that's first in, first out, while another uses LIFO, last in, first out. Now, if prices are rising, that one simple choice can completely change a company's reported profit and how much their assets are worth on paper. Okay, check this out. We've got two companies. Based on the numbers they reported, Company A, which uses FIFO, looks like it's in a better cash position. It's got a current ratio of 2.0. Meanwhile, Company B, using LIFO, is trailing at 1.78. Seems pretty straightforward, right? Well, not so fast. Here comes the magic. A smart analyst knows to look in the footnotes for something called the LIFO reserve. It's basically the difference between the two methods. We can use that number to adjust Company B's books to make it an apples-to-apples comparison. And look what happens. All of a sudden, Company B's current ratio jumps up to 2.22. It's actually the more liquid company. Our whole conclusion just got flipped on its head by one little adjustment. And that right there is the secret sauce of great analysis. It's all about digging into those footnotes and making the adjustments you need to make sure you're comparing what's real and not just what's on the surface. So, After we've looked back at the past, projected into the future, and adjusted for the tricky realities of accounting, our quest finally reaches its last stage, making the call. And this whole rigorous process is not just some academic exercise. This stuff informs huge, real-world decisions. Lenders use it to figure out if a company can pay back its debts. Investors use it to screen for stocks that fit their strategy. And ultimately, it's all about trying to figure out what a company is truly worth. So you see, by the end of this quest, the analyst has moved way beyond just numbers on a page. They've built a complete, three-dimensional picture of the business, and they really understand its health, its strategy, and its potential. And there you have it. That's the analyst's quest in a nutshell. Look to the past, forecast the future, and always, always adjust for reality. It's a powerful way to think. So I'll leave you with this. What story do your favorite company's financials tell? Thanks for joining this explainer.